What happens if you let AI build your investment portfolio? I asked 5 different AI tools to create portfolios for a beginner investor, then compared what they recommended. The results were surprising, and if you're new to investing, they might completely change how you think about building a portfolio. AI is everywhere right now, including finance. But can it actually help beginners invest smarter? So I gave 5 AI models the same prompt. Build a simple long-term investment portfolio for a beginner with moderate risk. Then I compared the results. Rules. Here were the rules. Long-term investing, 10+ years. Beginner-friendly. Diversified. No complicated trading strategies. Just simple portfolios someone could realistically start with. Let's see what the AI came up with. Portfolio number 1, the simple index portfolio. The first AI suggested something incredibly simple. Just 3 index funds. Total US stock market. International stocks. Bonds. This is basically the classic lazy portfolio. The idea is simple. Instead of trying to beat the market, you own the market. Pros: extremely diversified. Very low fees. Easy to manage. Cons: not very exciting. Slower gains during big bull markets. But for beginners, this approach is actually very hard to beat. Portfolio number 2, the tech-heavy portfolio. The second AI leaned heavily into technology. About 60% of the portfolio went into major tech companies and tech-focused ETFs. The reasoning? Technology has driven most market growth over the past decade. Pros: high growth potential. Exposure to innovation. Cons: much higher volatility. Risk of sector concentration. If tech struggles, this portfolio struggles too. Portfolio number 3, the dividend portfolio. The third AI built a portfolio focused on dividend-paying companies. Instead of only focusing on growth, this strategy prioritizes companies that regularly pay cash to shareholders. Pros: consistent income. Often more stable companies. Cons: lower growth potential. Dividends can be cut during downturns. For beginners who like the idea of passive income, this one was interesting. Portfolio number 4, the global diversification portfolio. Another AI emphasized global diversification. This portfolio invested across stocks, international developed markets, emerging markets, bonds, real estate. The idea is simple. Different parts of the world perform well at different times. Pros: risk spread across many economies, less dependent on one country. Cons: more complex. Some regions may underperform for long periods. Portfolio 5, the AI Future Portfolio. The last AI focused on future industries. It included investments in artificial intelligence, renewable energy, robotics, biotechnology. This portfolio is betting on the industries of tomorrow. Pros: massive potential growth, exposure to disruptive technology. Cons: highly volatile. Some companies may never succeed. What all 5 portfolios agreed on. Even though the portfolios were different, every AI agreed on a few key principles. Diversification is essential. Long-term investing beats short-term trading. Low fees matter a lot. Consistency is more important than timing the market. Those 4 ideas came up again and again. The most interesting result. The biggest surprise? Most of the AIs still recommended simple index funds as the foundation of the portfolio. Even the more aggressive strategies usually had broad market ETFs as a core holding. In other words, the boring strategy might actually be the smartest one. AI can generate interesting ideas, but it's not magic. The best portfolios are still built around timeless investing principles: diversification, patience, and long-term thinking. If you're a beginner, the goal isn't to find the perfect portfolio. It's to start investing, stay consistent, and let time do the work. And honestly, even AI seems to agree with that. If you want to see me test more AI investing strategies, subscribe and let me know in the comments what experiment I should try next.